Awesome. I think that we're connected. Hello, everyone. I'm Polly Speaks, and welcome to this fireside chat here at RWAs. I'm your host today, and we're going to talk about one of the most interesting questions in Web3. I mean, what kind of a questions are not interesting in Web3, though? How do we take real world assets, institutional capital, and decentralized governance and actually make them work together? And I'm very happy to have two guests with us. He come at this from very different but highly complementary angles. First, we have Samuel Chan, co-founder of Kula, who brings a background of quantitative trading, AI, data science, blockchain, a lot of different things. So with Kula focus on turning real-world assets into opportunities for communities and impact. And joining him is Philipp, Director of Institutional Growth at ZIGChain, bringing a strong focus on institutional adoption, regulated financial infrastructure, and distribution, of course. So we have a community-driven capital on the one side, institutional liquidity on the other side, and hopefully no shortage of strong opinions in the middle. But I hope actually that there will be some counterintuitive opinions. So let's get into it and explore what it really takes to bring RWAs on chain at institutional scale. But first of all, dear speakers, dear guests, feel free to introduce yourself. I would love to hear your personal stories, how you end up in Web3, how long ago was it, and who are you? What is your background? Maybe you can highlight some of the achievements, maybe some mistakes that you made so far while building what you're building right now. Yeah, Samuel, feel free to take the stage first.
Well, thank you very much, Polly, and great to meet everybody. So my background is actually in physics, physics and economics. I was mainly doing astrophysics type of work along with condensed matter. Long story short, I was building this algorithm to identify when there's supernova happening in the sky, how to differentiate that signal from basically different animals touching the sensors out in Australia. So in the middle of doing that, turned out that work was helpful for hedge funds to identify like corporate event versus market noise. So I got recruited. So just like most physics kids, you started trading derivatives. That's kind of my path. And during that derivative trading period, I started encountering blockchain and a lot of crypto trading, right? So build a portfolio, long, short, top 10 market cap. And then meeting with a few friends who are now co-founders, we thought it'll be a good idea to use blockchain for good, and how do we benefit the community using the technology. So we started Kula, which is a decentralized impact investment platform. And along with the investment activities we do, we tokenize multiple different assets and bring them on chain. And here we are talking about it.
That's unusual background story. I think that so far, as I interviewed more than 300 people, I have never heard someone going to Web3 for a master physics. Uh,
Yeah,
that's
it's fun. People, all walks of life, as you know, in the Web3 sphere. So glad to be a part of the
that's
little group.
fascinating. That's fascinating. I bet you never knew that you would love to be immersed in blockchain sphere as well when you
No,
started looking at
no.
supernova and understanding how how to differentiate it from animals touching the sensors. Well,
Yeah.
thank you, thank you, Samuel. And also, I actually love the fact that astrophysics can actually connect to hedge funds somehow, which is also pretty unusual. Supernovas trading models are not the career path most people would put together. Well, but your work
Yeah.
today, Ula, seems like a natural or like okay natural I would use that word evolution of the same mindset, right? Understand complex systems, find the signals, and then build better systems around them. And what especially interesting though, that Kula is not just using blockchain to create another digital asset, it's trying to connect blockchain with real assets and local communities
Mhm.
and investment decisions. So you can almost see the progression from detecting a signal in the universe to detecting opportunities that traditional finance may have missed. So I think that is one of the strongest stories in Web3. Sometimes you do not enter the industry because you plan to become a crypto person, but because you
Mhm.
find a technology that gives you a new way to solve a problem you have been thinking for years. Wonderful. Philip, try to try to compete with that.
Yeah, I don't think I'm gonna compete. I think we're just gonna let him stand there, and I'll try to do my bit. It's not as glamorous. I started my career as a scruffy entrepreneur. With my second venture, I actually got my beak wet in the Web3 space. That was 2015, when we started taking advantage of the kimchi premium that started existing around that time. And then shortly after, as the sort of spreads were getting smaller and smaller, I had my first try in the asset tokenization space in around 2017, when I thought that tokenizing independent film would be a game changer for the independent film industry. I still think that there's a good opportunity there, but obviously timing wise, technology wasn't ready. None of the market participants really wanted to kind of contribute to structures like these. Whilst I still think that independent is a very investable asset class, if and a layer of data is added and analytics, especially with AI and stuff, it's just completely wrong from the market timing perspective. But hey, I'm back now. I'm back now after a couple of detours. I did some kind of institutional venture capital on behalf of the Dubai government in my previous role. So we set up a VC vehicle on behalf of the Dubai government entities, kind of supporting both local startups as well as investment funds. And before that, I did a bit of a stint with Microsoft, setting up their business startup unit across the Middle East and Africa region as well. Now I'm with the ZIGChain team. The team has been kicking around in the tokenization and crypto space for quite some time. Started their journey in 2017 by founding a company called ZIG that grew to about 2 million investors at some stage. And then through kind of customer feedback from the ZIG customers, the team ventured into RWA, and that was purely from the need for diversification. You know, the times were very volatile in the market, and a lot of the platform investors were asking for new asset classes and new diversified strategies to invest in. So the team basically propped up their own balance sheet to develop a tech stack and a legal stack that allowed them to compliantly bring real world assets on chain. Today, we have a very simple mission. We basically want to open up traditionally closed asset classes to the rest of the world, and the specific focus for us is emerging markets. We were actually the first company to bring regional private credit on chain. That was published in World Economic Forum earlier this year, and we've kind of been very busy since then. I'm happy to go into the details of what we've built, how we're kind of commercializing all of that whenever it's the right time now.
I would say this is also a pretty great example of how sometimes you can have the right idea but simply arrive a few years too early, which is actually good. Um, Tokenization of independent films. I think it is possible right now in terms of readiness of market participants, and technology is definitely ready, especially with your background. It sounds like I can connect you to some Hollywood guys if you want. I have some people.
I still have my Hollywood scars from that time. So I'm okay. I'm definitely okay from that. Actually, you know, and it's an interesting point, because yes, technology is ready. Maybe there will be some investor interest as well, but sometimes the question is whether the asset class itself is ready. You know, and if you're kind of familiar with how payout structures and just legal wrappers of these film projects typically work, you know, you will understand very quickly why tokenization of the film asset class as a whole will never be a scalable asset class that anyone will tap into for now, anyway. You know, and I think, you know, the complexities exist across industries for a reason. Sometimes, let's put it that way.
But I like that you didn't just like walk away from that idea. You went on to work with the institutional structures and government related projects, maybe who are more appropriate for the market timing right now, which I think gave you a much deeper understanding of how serious capital actually moves. And now coming back into Web3 through ZIGChain, it sounds like you are seeing the same idea again, but this time with much better infrastructure and market that is finally paying attention, which is good, especially with Clarity Act coming on again. I recently posted a whole, I would say, an article. So we're moving in the right direction. And I think that we have definitely seen that with tokenization, with major financial institutions now exploring blockchain based versions of traditional assets. The journey going to be quite interesting, quite tricky, though everything seems to be summing up in a good manner. So thank you for coming back, Philip. And I think that after our round of introductions, we can start our discussion here. And you both, Kula and ZIGChain, focus on bringing tangible financial products and real world assets on chain, right? From your perspectives, from your positions, one focusing on community aligned impact in emerging markets and the other on institutional growth and distribution. What are the biggest structural bottlenecks currently holding back mainstream institutional adoption of RWAs? If we're going to touch regulation, okay, we can do that, but let's not make that obvious. Maybe there are some hidden bottlenecks. Samuel?
Maybe, yeah, I'd love to get that conversation started. I think the tech is probably not the bottleneck, really. I think the bottleneck lies in perhaps the trust architecture. And there are probably two layers to that. One is enforceability. So we deal with a lot of emerging markets as we do impact investment. What we realized after a bunch of tokenization type of work is that for example, a land title on chain doesn't really mean anything if the local court doesn't enforce it, right? So to us, this is why today's RWA market almost is entirely in treasury and gold, because those assets whose off-chain claims were already recognized. So what we need really is to work in a way that the local courts and their jurisdiction really recognize the tokenization. So at Kula, we're pushing for what's called a title tokenization. It's one of the ways for us to link that. So we work with regulators in East, Southeast Asia, and Africa, and many other places, Europe and North America, to get that framework done. So that's kind of number one. The second thing is because of the impact investment we do, it's really the standardization and a transparent way to measure and demonstrate the impact. So a lot of impact investors so far, they're collecting kind of bespoke impact reports, and which doesn't really have much of a transparent track record or proof. So for Kula, recently we published an impact dashboard on all the projects we invest into. So far, it's been like kind of like a pilot, so it's like a couple of them. And these data is collected directly like on chain and then being reflected onto our dashboard. So we're hoping that would be the first step to solve this problem.
Amazing. Maybe I can just add to that, Paul, if you don't mind. So I agree with a lot of the things that Sam just said. I think the premise that a bottleneck is technology or even regulation, I would go as far as that, is false in my opinion. Because, so if you look at the Clarity Act and kind of how that's been evolving over time, we've now come to a point where the underlying assets continue being governed by the same rules that they've been governed by for the last 100 years, right? And so the asset rules don't change, adequate structures for these underlying assets don't really change. But what we're really talking about when we talk about asset tokenization is adding a digital layer on top of these original structures that allow us to reach new people and allow us to build new product features on top of traditional assets. All right. So in my opinion, the bottlenecks today are not issuance, whether that's from a technological or a regulation point of view. It is definitely distribution. So if you look at around, I think there's about 7,000 tokenized products there live today. And only really one asset class, or maybe two, such as US Treasuries, has really established themselves as production ready, where distribution is starting to be built around it through stablecoin issuers and whoever is using these instruments for their day-to-day business. Everyone else has just kind of built a tokenization factory, and that's what people have been competing on. But no one has really built a sales force around that, right? So and this is really like our number one objective. Instead of just trying to rinse and repeat what's been happening in the market so far, we're heavily focused on establishing unique distribution and networks around the products that we ultimately bring on chain. So from the issuance side, we are heavily driven by the demand of our distribution networks. So we don't pick the asset and then a tech stack and try to find a home for it, but instead we ask the end customers, the end distributors, what type of asset characteristics are you looking for? What legal jurisdictions are you comfortable with? Which tech stacks have you evaluated and have you greenlit that you're comfortable with? And then based around those facts, we start switching on our asset tokenization factory. So for us, biggest pain point remains distribution. And we're very much at the beginning of it all. I mean, if you look at the total RWA market today, I think the market claims to have around 300, 400 billion US dollars worth of assets tokenized. Yeah. If you then kind of look into that number and see what's been distributed, it's not even 10% of that. Okay. So that just means that we're so early along the curve. And the reason for that is what Sam just mentioned, right? Enforceabilities, the right legal wrappers, the right technical wrappers around these assets, which actually would allow institutional liquidity to flow into the digitized version of the assets that they're already exposed to otherwise.
Awesome. I really like that both of you pushing back on the idea that technology is the main problem, because the technology is actually moving quite fast, right? Samuel, your point about trust and enforceability is especially important. If the legal claim behind a token is not clear, then putting it on a blockchain does not magically solve the problem. And Philipp, I agree with your point that tokenization is really about adding a digital layer that can help assets reach new investors and markets, not just creating another token. Tokenization is easy by itself, right? But the interesting part is that we already have thousands of tokenized products, but the market is still heavily concentrated in simple assets like government treasuries, which tells us that issuance is much easier than real adoption. So maybe the industry has spent too much time asking, can we tokenize this, can we tokenize that, but it's not enough time asking, can people actually trust it, understand it, and buy it. And I also really like that what Kula is doing with on-chain dashboards and working with the regulators, because transparency can turn impact reporting from a stack of PDFs into something investors can actually see and verify. So I think that ultimately it feels like the next big step for RWAs is not proving that tokenization works, but proving that these assets can build trust and find real distribution at scale. And maybe follow-up question to this before we go further. How do you think, both of you, what needs to change for tokenized assets to move beyond a small group of early adopters and actually reach mainstream institutional investors? So how we scale the distribution?
Actually, just before we jump into that in detail real quick, I want to just appreciate, Polly, that you invited Philipp here, because in the beginning of the talk, you're like, oh, maybe there's some debate going on here. And just from his answer and where we stand, I really don't feel like it's a debate. I think we work really well together in that sense, because distribution is certainly important. But distributors will need, asset originators and deal originators like us, right? Like where we find the actual asset that's interesting enough for the institutional space, and then we build it in a way that's legitimate and trustworthy, so that the distributors will be comfortable presenting it, to the final buyer. And of course, we have the retail and institution type of breakdown there. But so I'm really glad to be having this conversation. But back to the topic at hand, I think readiness has a few kind of components. One is the fact that from the deal origination, almost like a supply chain layer, right, all the way to the end, is all legally recognizable. Technology. Hopefully, it's in a way the title and everything is built into the code rather than just the wrapper around it. And then all the way from there is the fact that there is deep liquidity in the market. And frankly, given a little bit of my trading background, a derivative market is important in this regard, because part of it is really about yield generation. Like, you could have an asset tokenized sitting there without any kind of yield, for example, physical gold. Without the derivative market, it's not going to be interesting enough, I think, to be a place to park your fiat into. And when I say fiat, I mean like kind of like fiat and crypto or whatever, like basically the currency into as like an asset class. So if we can build a deep liquidity around stuff that we are trying to tokenize, I think that would be an interesting space to explore. I'd love to hear from Philipp too, because he's dealing with all kinds of end customers.
Yeah, look, I also echo what Sam said. I think there will be, from what I've heard so far, there will be very little disagreement, and it's really refreshing to see. And funnily enough, because I disagreed so much with everyone else in 2017 in the industry, that made me leave. Because I feel like the industry is just curing itself from and by the industry I mean the Web3 blockchain space, is just curing itself from a disease. Where tech experiments have been seeking adoption somewhere, or they've just seek for justification to warrant the amount of money that has been put into those experiments. Okay, and I feel slowly but surely, that is coming to an end, which has personally enticed me to go back into the industry and do real customer-centric business at the end of the day, right? So I think the winners will very much be defined by the entities that know their customer bases the best and the most, and build their structures, whatever they might be in whatever asset class, around those customer demands, right? And ultimately what we're going to end up with is real companies solving real world problems. For us, one of those problems is access to different asset classes across emerging markets. So for example, one of our co-founders, he's originally from Pakistan. After having a successful exit in his previous venture, I mean, he made a little bit of money, and still at that time, as a full-time Pakistani resident, was struggling to get exposure to US equity markets, right? So there is that real need for creating those access rails. So this is kind of very core of our company's missions, in order to basically make asset classes accessible by people who don't have access to banking rails for now. I mean, that's kind of being solved by the stablecoin provider, some of the fintech neobanks and stuff like that. And what we're trying to offer into the stack is really the wealth layer, where we say to wallets and to neobanks, you continue doing your cross-border remittance, kind of current banking services for the customers that you garnered some trust with. If you want to offer investment products, here's a single plugin that gives you access to a shelf of products that you think, with the right structures, fit the demands of your customer basis, right? So I think it's actually very simple. So if we just go back to like business 101 and we start focusing on the customer problems, then this whole debate about adoption, which asset is going to get adopted first and how much traction we're going to get, is going to abstract itself away, in my opinion.
Okay. I think, thank you so much for answers. And I think that you both are pointing to the same big shift, as I can catch it. We need to stop building tokenized assets just because we can, and start building them because investors actually want them. Samuel, your point about the full journey from origination to deep liquidity is very important because an institution does not just want to buy an asset, right? They also need to know how they can manage the position and eventually exit. And coming from your trading background, the point about yield makes a lot of sense to me as well. Investors still want returns, right? Even when the asset is on chain. And Philip, I laughed at your comment about the industry curing itself because there has definitely been a period where the technology was looking for a problem to solve. But I really like your example of your co-founder from Pakistan because I think that I actually met him around 3 years ago on one of the conferences. I even have a photo with the merch of ZIGChain, to be honest. I will try to find it. Not sure if I have it somewhere. But the point is, you're not just talking about abstract financial inclusion, but about people who simply cannot access certain markets today. I'm that person. Like I will not tell to live stream what kind of a citizenship I have, but probably you can notice. So I'm voting for that idea, and I think it's extremely correct and right. The idea of a wealth layer is powerful because it suggests that Web3 can become less about crypto itself and more about giving people access to financial opportunities that were previously difficult to reach. But like, okay, what do I do with the capital that I have, but I can't just access some assets like US equities? So maybe the real winner in RWA will not be the company with the most impressive technology, but the one that understands the investor and delivers a useful asset and makes the whole experience feel surprisingly simple, I would say. But if I'm taking a little bit different turn here, I would love to touch the point on balancing compliance with decentralized governance, which is a tricky one. Samuel, Kula utilizes blockchain-based decentralized oversight to direct capital toward emerging markets responsibly, and Philipp ZIGChain emphasizes institutional frameworks and regulated finance through ZIG Markets. From your perspectives, how can the industry reconcile strict regulatory compliance with principles of decentralized government? Maybe I would exclude the term community driven, but I will still keep decentralized one. Who wanna go first? Samuel?
Well, I went last, so I'm gonna go first again. Maybe we'll switch later, Phil. I think like so compliance layer, I guess answer the question like who may hold this. So it's like a who question, whereas the governance layer perhaps talks more about what should this capital do. So compliance lives really at the asset layer. So for Kula, because we're FSC Mauritius license, so our license scope is pretty narrow by design, right? So custody, advisory, issuance, distribution, exchange, all that stuff is walled off from a separate entity. So on chain, we have built a set of ERC standards for tokenization, and hence that title tokenization part of work that I talked about earlier. And we're using existing ERC standards as well for so investors could identify and enforce those tokens, enforced by those tokens themselves. So the regulators' requirements are built into the entire workflow. So that's how the compliance layer for us could live. The compliance could live at the asset layer, whereas a community governance, it lives at the allocation layer. So the regulators might care about like who custodies the asset, who advises it, who distributes it, but they probably will care a little bit less about, our community member, like a fisherman, like how do they vote on which project they're funded first, right? So the communities will govern different priorities, the project selection, how the impact is being accountable to everybody else. So it's really about the execution and allocation layer. So these two things work hand in hand, and it's really like an entire workflow that we care about.
Yeah, maybe I can add to that as well. So again, hate to be boring, but I fully agree once again. Big key distinction I think here to make is sort of governance of a protocol and then governance of the asset, right? It's two different things. As Sam mentioned, governance of the assets sits within a traditional structure, and there needs to be a name associated with that structure, because regulators need to blame someone in case something goes wrong, and that cannot be decentralized. So typically these decentralized protocols are very good at making decisions in general, right? So you can vote on things, but they're not very good for liability reasons, right? So once things go wrong, who's actually accountable for that if the decision was made as a collective, right? You can't put every single person that's partly anonymous in front of a jury and jure them for fraudulent activity, right? So they're kind of two separate topics actually baked into one, and the industry typically gets that wrong. So it's not one or the other. I think the sweet spot is really in the middle, where now we have a way to democratize decision making and voting around strategies, around whatever it might be, and then combine that with the rigidity of traditional proven structures that have got governing bodies watching them, specifically regulators. Right. And I think that it sounds like there's a compromise, but I really don't think so at all. Right. So even if then, a tech layer of a particular product will get hacked, there will still be that bankruptcy remote vehicle in the background that's protected by the local regulators. So I see this as not really that much of a discussion, to be honest. And I think anyone who claims in the industry that it's any different, I think hasn't yet sold their products to anyone at scale. But ultimately, I believe, and what excites me personally and us at ZIGChain, is both of these structures sitting in harmony side by side.
Okay, I will have a follow-up question to that, but I actually think that it's pretty important distinction. Maybe it makes the whole debate much simpler. Samuel, your point that compliance belongs mainly at the asset layer makes a lot of sense. I wrote it down, by the way, because the legal ownership and rules around assets still need to be very clear. And at the same time, putting community governance at the allocation layer, I think, gives people a meaningful role in deciding where capital should go and what priorities matter. And Philip, I like your distinction between governance of the protocol and governance of the assets, because those are really two different jobs. And thank you for that point. You can have a decentralized protocol while still having very strong rules around the specific financial products, just like we have rules around banks, even though customers can decide how they use their money. In fact, I think that trying to decentralize everything could sometimes create more problems than it solves. And sometimes you really do need someone responsible when things go wrong. So perhaps the future is not about choosing between regulation and decentralization, but about putting each one in the layer where it actually works best. Though the question in my head was, as a follow-up to this discussion, how do you think what kind of a parts of decentralized governance institutions still genuinely struggle to accept? Like, what would need to change for them to trust it?
Okay, can you repeat the question again, Pauli, please?
Yeah. What is one of the part of decentralized governance, or like what we discussed just now, that you think institutions still genuinely struggle to accept?
Well, I think it's just also a very broad question, which is difficult to answer from my perspective anyway. But look, I think what decentralization ultimately means is democratization, and institutions typically don't like to democratize their decision making, right? So I think they're kind of like two stakeholders that are being catered for by the RWA space in my mind. There's the end investor that doesn't have access to certain asset classes today, which now RWA tokenization changes. And then there is the institutional allocator that looks at this whole opportunity in a completely different way. So the game that you see in the US, for example, is a very like an operation efficiency type of game where using a blockchain, like a blockchain is ultimately a ledger, right? So if a lot of entities that typically transact with one another suddenly go into a network that cuts out some middlemen, transactions typically become easier, faster, cheaper. We've heard it all, right? And then this is a lot of the US kind of institutional game that's happening right now. The second opportunity is obviously the access piece, where some of these vehicles, can now go after different investor classes, where this becomes really, really interesting. But the real innovation of this whole game is that traditional assets can get new product features. And what I mean by that is that, for example, in private credit, it is really hard for institutions to take leverage in some cases, right? So now lending markets across DeFi enable that. Maybe there's a financial opportunity for institutions there under the right structures, right? And this is kind of going back to what we've previously said. The structure never really changes for them, whether it's got a digital layer or not on top of it. But it might open up a commercial opportunity, right? So this kind of like composability part, I think, is a very big kind of deciding factor for institutions, and they're just starting to wrap their heads around the kind of the associated risks with that as well. Because some asset classes or certain niches within that asset classes are very risky to lever as well, which the market is slowly starting to understand. And then the second part is you can build secondary liquidity layers, so secondary markets on top of traditionally dumb assets now through a new tech stack, which is also very interesting. Suddenly broadening up distribution to new investor types. But what I mean by that is think about a traditional private credit fund with a minimum lockup of 6 months. If you start building a digital secondary market on top of that, maybe liquidity can be reduced to a monthly basis, maybe a weekly basis, depending on the underlying strategy, right? So I think these are the kind of interesting things for institutions, and it's not so much of a structural or technological question from my point of view, but the question is, what is the commercial opportunity associated with this new risk that they would be building on top of their already well-established stack?
Maybe if I can add to that a little bit from perhaps the deal origination component or the side of the equation, is I think decentralization for us, it perhaps deepens the capability for deal origination on our end, because it's attractive, to the asset owners themselves, like on the ground. So like Philipp said, it's not like institutions, the entire playbook didn't really change for them, because to them it's more like asset allocation game at the end of the day, like, okay, risk versus return, right? But some of the deals that we saw on the ground, like in Africa, in Kenya, Zambia, all the places we've been to, or Southeast Asia, they were not trained to think about in the risk versus reward type of mindset, which is the institutional playbook. They just wanted to go fishing, and they want to get the thing and maybe do some good to their community, which could be small or big, right? But some of them, when they started, they didn't know how big the market was. They just wanted to do something given the skill that they have. So when we approach these asset owners and we say, oh, you can actually vote on how, when, how much to utilize the asset that's under your feet and turn it into capital that could be in your hands. And we're here to give you that, that access. And we in a way like empower them to do so. We distribute the 20%, token to them in the both profit. We see their eyes lit up. And part of it isn't like about the money. Many times from what we've been dealing with, it's the very first time for those asset owners to get to vote on like anything. So there's this like self-realization of worth that their voices matter in the entire process. So to us as impact investors, we find really heartwarming for that, right? It's like a change moment, in people's lives. Now back to the asset side, because of that, we almost kind of, I guess, uncovered a class of assets that would probably never really fit into the institutional playbook, but we're able to create a portfolio on them. And maybe later we can talk about kind of asset allocation we want to and all that stuff. But I think then it deepens the entire kind of the reach of those capital from institutional guys into these communities that were never really eyeing that.
Deep. I love it. Yeah, 1 second. I'm just digesting. Sometimes my brain can be very immersed in the story itself, and like I have the cartoons here, visualizing how self worth realization happened to some person of who
Mm,
owns the asset. I'm like, oh, sorry. Yeah, the reality is here. So going back,
yeah.
I think that that was a very honest answer, Philip. Firstly, you, because the tension is not really about the technology; it's about who gets to take decision. Right? Institutions are used to having clear decision maker, while decentralization says that more people can have a voice, and that can feel uncomfortable when you're managing billions of dollars or trillions sometimes. And I also like a point about access, because the really interesting part is not simply putting traditional assets on chain, but giving them new features like better liquidity or more flexible redemption. And the private credit example is a good one. If technology can safely reduce a 6-month lockup towards something closer to monthly liquidity, that is very meaningful product improvement, not just a blockchain upgrade. And Samuel, your point about deal origination is equally important from my perspective, because decentralization can bring new opportunities to asset owners who were previously invisible to global
Mhm.
capital. That's a good word, probably. I will remember that. Uh, and when
Write that
people,
down.
yeah, yeah, thank you. I will.
You have your notes going on there.
Yeah, I mean, I do. This is actually like people. You sometimes people forget how to use a pen. Now we have AI note takers, but to be honest, when you're writing something down, your brain perceives it better. So
Mhm.
I'm old school on that matter. I don't know. And yeah, to be honest, when people in emerging markets start to see that their assets have value and that their voice actually matters, that is much deeper form of financial inclusion than simply giving someone a digital wallet. So I think that the interesting opportunity here is where institutional capital gets better products, while local communities get better access and
Mhm.
visibility, and I would say a real say in the process. Okay, maybe we can go now to a little bit another topic of our discussion as well. Origination and structuring. I think that Samuel will like it. But Philip, you can go first with an answer on that one. Philip, with your focus on the distribution and origination of on-chain assets for ZIG Markets, and Samuel, given your background in and trading and investment design, what does the technical and financial architecture of a truly institutional grade on-chain asset need to look like today?
Cool. Yeah, happy to take that. First of all, I don't like the term institutional grade because it's a little bit misleading and confusing, because it means that that is superior to everything else that exists, and that is not necessarily true. But maybe that's another question that we can get into after this one. But let me just kind of give you the breakdown of what kind of structuring or the stack looks like for us. So at the top, you've got the one topic that I've keep on banging on about, which is distribution layer, right? So we've got the wallets, the exchanges, the neobanks, custody providers, whoever sits between our assets and the end investor for most cases. And that investor can be institutional or retail. Yeah, it depends. And which structure fits for what end investor really depends on, you know, a couple of aspects. Then underneath that, you've got the structuring part, which is basically the legal wrapper where the risk sits. So you've got, you know, the legal wrapper, the redemption waterfall, subscription mechanics, and all of these kind of things, which then has a digital layer on top of it, which is the vault infrastructure. Yeah, and this basically then echoes the dynamics of the legal wrapper to a certain degree, right? In that vehicle, you have the strategy or the yield source. So they're kind of like two different ways of doing things. So it could be either a fund that decides how to allocate and when to allocate. So you could add a decentralized governance structure into that for certain vehicles, or have a centralized fund manager in the middle. Ideally, a regulated one, because most of the curators and fund managers in the industry are completely unregulated. And therefore shouldn't be doing this type of activity. Or what we're doing quite a lot of stuff of is a single asset for one legal wrapper, right? Where you basically segregate a specific SPV that feeds into a single asset or a single, you know, centralized traditional fund. And then that legal wrapper is tokenized and digitized for distribution. On top of all of that, so these are kind of the core three stacks, I would say. You also have risk management and liquidity management. The market today looks predominantly at technical and smart contract risk, right? So this is a very sort of like crypto OG way of looking at things, but this is starting to change now. And we're really digging into the weeds of asset risk return profiles. And this is where we see a very big opportunity for ourselves as well.
If I could, I think you answered it really well from the entire, you know, the compliance, legal, distribution side of things. You mentioned, you know, probably like earlier about my, I guess, the quant trading background. A little bit on that is in trading, right? None of these mathematical models the quants come up with would really go into production without a validation. And the validation has to be done by someone whose, I guess, bonus doesn't depend on the model being passing, right? Because otherwise it's just complete bias. So for the impact investment side, I would think it's the same. So in the TradFi world, you know, we have the auditors, right? And in the DeFi world and in our kind of space, the independent validation still survives, right? Like so the blockchain will then come in and play a very big role in that, because then you can imagine the whole entire DePIN type of IoT, you know, space to measure the impact you're making on the ground and then connect that on chain when then it's immutable, right? So it's really open, transparent for anyone to see. So make the independent validation work much easier. And I think the institutionals, you know, will really appreciate the fact that there is something out there that's independent. So little bit, I guess, deviation from the entire RWA conversation is if you look at the impact space with all the, you know, the UN SDG, you know, GIN type of space, adding together, there's about 1,300, 1,400 indicator metrics that's used to measure the impact. And if you think about how many of which could actually be independently measured, it's a whole lot fewer because some of the data has to be provided by the asset originators. So there's really not true like independence. Independence means like me as a validator, I don't go ask the asset originator, I can just find it myself, right? So for example, when we invest into projects like because of underground water, for example, how clean the water is, you know, is it drinkable? That type of stuff could be measured with the device, and we could do that on ground. But if we say like, you know, has your supplier being paid, you know, last year, perhaps we can really find the supplier, right? But in most cases, it has to be kind of, you know, self-reported. Equal pay between men and women, you know, that's another thing that we could kind of ask the community. But how independent that is remain debatable, right? So I think that part is the validation component. Another component I think that's important for the institution is if you look at all the failures happened in the past like decade or so, there is this kind of like for the platform, to issue a token and then use another mechanism to prop up the token, or if you borrow against the token, and then you take the money to buy your token and then prop it up. There's a whole circular reflexive type of way to support the token price. That cannot happen anymore, I think, in an institutional space, right? It's like I'm not saying I'm against like derivative market, like margin calls, on just normal equity space. That's okay because the entire margin space, leverage space is separate from the companies that's issuing those equity, right? But if the companies go out there and use that derivative to go support their own equity price, that's a no-no. And I think that has to be reflected in the decentralized space as well.
Okay, Philip, I can see that you agree by nodding. But yeah, I like the pushback. By the way, Philip, from institutional grade, that's why I highlighted it like this, because usually people on Twitter, in all articles, in Cointelegraph, and all different parts, they're using institutional grade, especially this word, to make it superior. Well, no, but anyways, sometimes it can sound like we're putting a fancy suit on the type of finance and calling everything else inferior. What you're really describing is a system where every important part has been thought through, from distribution. Yeah, is a like from distribution and legal wrapper to redemption, vault infrastructure, yield generation, risk management. That is much more useful way to look at it. And Samuel, your comparison with the quantitative trading also really lands, because no serious trading model gets deployed just because someone says, yep, spreadsheet looks good, let's do it. So you validated, you tested, you monitored, and ideally have an independent people checking the assumptions. And the same logic has to apply to on-chain assets, especially when real money and real world projects are involved. And your point about impact measurement is pretty huge. There are more than you said, 1,000 different projects.
1,300, 1,400-ish.
Jesus Christ.
Some of them duplicate.
Yeah, anyways, that's it's hard to say. That is pretty simple, right? And the investment has an impact. It's not exactly enough, but for me, as a summary, as I can calculate in my brain, um, where the real institutional opportunity sits, it's not making Vapre look more complicated though, but making the whole investment process more measurable and verifiable and understandable. And as I just look at the time right now, we have around 7 minutes left on air, which and discussion felt like 10 minutes. So thank you for being interesting guests. Time flies. Maybe the last final question that I will have, and you can just shortly say. So RWAs have finally moved from an interesting Web3 experiment into real financial infrastructure. Um, can you agree with that or no? And how do you see the future of Web3 in a couple of years, 3 to 5 years from now?
Maybe I can kick us off. So I don't think we're quite there yet, but we're definitely evolving into that direction. And I see this as like a clear indication of Web 2 and Web 3 markets finally merging. There should have never been made a distinction in the first place, in my opinion. And I think that the next couple of years are going to be defined by products being structured and distributed to investors that don't even know what rails they've been delivered onto to them, right? So ultimately, we want to abstract all of the kind of industry jargon, all of the industry complexity from a usage perspective, and simply become an infrastructure underneath the hood that no one asks any questions about, right? I mean, if you do buy your Mercedes car, you don't evaluate the different pipe brands that have been put into it for a particular edition of that car, right? You just expect it to give you a certain feeling when you get into it. You expect it to be faster than maybe some more inferior cars on the market, and you expect it not to break, right? And I think this is these are the kind of analogies that will define the next phase of the RWA evolution, hopefully. So yeah, if I was to kind of say where we are today, it's definitely very much at the beginning of it all. We're just coming to the realization that there's real customers to serve with the technology that we've been dabbling around with for the last 12 years. And now we're trying to figure out the best user experience and the best user interfaces for that interaction between product and users to happen.
Following his example, right? Like when you buy a car, you kind of expect the engine to be in the car, right? So in the same way, I think, later on, like blockchain will be probably integrated into the plumbing of the instruments. So, maybe the space will be a little bit more, I guess, boring. I'm not sure if that's the word, right? It's like, like you said, Philip, like nobody talk about like, the are you HTTP versus HTTPS nowadays, right? Like who cares? Like, yeah, it's in there. It has to be secure. So I think that would be, in a way, like boring is good, for institutional space, right? RWA and everything, like people expect it to be on chain, expect it to be tokenized in the regulated manner, expect the stuff to be transparent, like we can see it right away. Fractional ownership would just be normal, because why wouldn't you, have the ERC20 wrapping, and then NFT, whatever. But none of that tech stack will be talked about because it's been there, or it's standardized. So it's from a technology, like just perspective, like, I obviously, in my head, every future is like this exciting thing. So boring is not the right kind of direction. But I think from an institutional finance point of view, boring is good. We want to have repeatable stuff.
Awesome. I agree with both of you. I hope that we're not at the beginning of the end. I hope that we're just at the beginning. And boring is really good, especially for institutions and for retail, for everyone. It's just more safe. It's safer. It's just safer. But yeah, I think that we can agree that putting an asset on chain is probably the easy part, though. The hard part is building the trust and regulation and liquidity and distribution, governance around it. And as we're wrapping up our session, I wanted to say that I really enjoyed about what I really enjoyed about this conversation is that we moved beyond the usual tokenization can change everything, it will change everything story, and talked about what actually has to work underneath it. We heard how institutional capital needs risk controls, while communities still need participation and visibility. Kula is already working toward that model with projects across different areas. And ZIGChain brings another important piece of the puzzle: institutional distribution, financial infrastructure needed to connect these assets with larger pools of capital and put those pieces together. And real opportunity is not simply to put traditional assets on blockchain, but to rethink how capital moves and who gets to participate in that economy. I would love to extend a huge thank you to you, Samuel, to you, Philip, for joining us here at RWA Week. Thank you, everyone who joined us as a listener, as viewer. Our panel, our chat will be available on Spotify as well. And yeah, if you guys have a final word to listeners or to each other, feel free to speak up. It was a genuine pleasure. Thank you.
Thank you so much for having me.
Yeah, thank you very much. Appreciate
it. Thank you again, everyone, and we will be back next week. I hope so. So yeah, have a good rest of the day. See you soon. Bye-bye.
Bye.